Well, joining me now with more on the markets and the economy and how to position yourself in this environment is Chris Fasciano. He's the Chief Market Strategist at Commonwealth. Chris, great to have you in studio.
Good to be here. Nice to see you again.
Yeah, it's great to see you as well. And certainly a lot of headlines for our viewers to follow these days as we see the markets respond in real time. What's on your radar?
So this has been a really interesting market, right? As you mentioned, headlines have dominated the market almost since January on a day-to-day basis. And the thing with headlines is they change every day, right? So yesterday, markets rallied because there were stories out there that things looked like they were improving in the Middle East. Iran was reaching out to the U.S. and Israel to start conversations. Today, those headlines have changed. As you mentioned, President Trump left the G7 to come back to Washington to deal with the issue. And it feels like now maybe we're at a crossroads as to whether we get to negotiations or this ramps up, and there were stories about what the U.S. involvement might be if it ramps up. So that's weighing on investors. I still think it's short-term headlines. My guess is that eventually we'll get to a negotiated settlement of some kind. And that brings us back to the second story you mentioned today, right? It's been a fascinating market to me because if you look at where the market was in January and where it was today, it's basically at the same place. But a lot's happened in between. But that leaves us, we come into the second half the same place we did in January, cautiously optimistic, but with concerns. And the reason we're cautiously optimistic is the consumer has continued to drive the economy. And now we're starting to see some softness in retail sales, which needs to be on the radar.
Okay, so with retail sales dipping 0.9% last month and a downward revision to a decline of 0.1% in the month of April, what does that tell you about GDP growth for the second quarter?
Yeah, I still think GDP in the second quarter is going to be positive. Our view is that barring any unforeseen events, there was so much momentum in the economy coming into this year that it's allowed it to persevere through a lot of these headwinds. But the key continues to be the employment data going forward, and that translates into consumer spending. So this softness is concerning, but until we start to see the jobs market go negative, I continue to think the economy will grow, earnings will grow. That will be supportive for equity investors, but I don't think the volatility we've seen this year is going away anytime soon.
And certainly some of the choppiness that we've seen the past few days, I guess, since tensions really escalated, of course, on Friday. We had seen the S&P 500 trade just about 2% from its all-time high. So with this volatility, should viewers be prepared for range-bound activity ahead, or do you think there could be a breakout one way or the other?
Yeah, one of the fascinating things about this market for me is we've had this great rally up 20% plus for good reasons, right? The worst case scenario on tariffs was taken off the table. But one of the things I've been thinking about is, are investors willing to look through some of these negative headlines? Because I do think that we can get to a better place by the end of the year and head into 2026. One of the things we haven't talked is key to that is passing the budget bill and getting some stimulus in the economy. And there are also headlines coming out that there's concern within the Republican Party in the Senate about getting that bill passed. But so I think range bound is probably true. As I said, volatility is here to stay. And I think you can use that to your advantage, but I think a lot of bad news was discounted in the market in April.
Interesting. So certainly anyone who bought at the bottom probably, saw a gain of almost 18%, to say the least there. I do want to talk more about some of the gyrations that we see in the markets and how that is impacting the economy. So oil, for instance, right, since Friday, we've seen some pretty big spikes in oil. Yesterday it had stabilized a little bit, but with these gyrations in the oil market, how does that impact consumers' wallets?
Yeah, absolutely. That is one of the keys. Our cautiously optimistic outlook hinges on no unforeseen events. And one of the unforeseen events, if this conflict in the Middle East continues or escalates, could be a spike in oil, right? And if we start to see a spike in oil translates to higher gas prices here, which starts to tick up inflation again, which, as you mentioned, the Fed's meeting tomorrow, that's certainly on their radar, then I think that has concern for consumer spending even more so going forward. And as I said, the economy has enough momentum to power through, unless something else happens. And if that starts to happen, I think you start to get worried about what economic growth in the back half could look like.
So how are you advising your clients position themselves in this environment?
Yeah, well, I never think you can time the market. We've seen that in spades this year, both at the bottom and at the top. So I continue to believe the best thing that you can do is make sure the portfolios meet their long-term objectives.
Yep.
And unlike the last couple of years where it's been all about the Magnificent Seven and large cap growth,
Yes.
I think diversification has worked so far this year.
Yep.
And diversification is likely to continue to work as we work through these headlines and this uncertainty. So that includes value. Sectors like industrials,
Yeah.
materials, financials have acted well this year.
Yeah.
But it also includes an international
Yep.
allocation as a hedge to your U.S. positioning. So diversification across equity and fixed income, I continue to believe, is the best way to navigate this market.
All right, Chris Fasciano, he's a chief market strategist at Commonwealth, joining me in the studio this morning. Chris, thank you.
You're welcome. Thanks for having me.
Yep.